You've probably heard the news. Once again, the Fed is considering keeping interest rates unchanged. But what does that actually mean? What does it mean when the Fed raises, lowers, or keeps interest rates steady? How does this affect financial markets, and what are the reasons behind such decisions? In this video, we're going to answer all of these questions, and from now on, whenever you hear about a new Fed decision, you'll easily understand what it really means. So let's get started. The truth is, many people who call themselves investors still have no idea what the Fed even is, let alone understand what changing interest rates actually involves. So first, let's briefly understand what the Fed is and why it's so important. The Federal Reserve System is the central bank of the United States. Its main responsibilities are to support maximum employment and to ensure price stability. That means keeping inflation low and steady. One of the most powerful tools the Fed has to reach these goals is the interest rate. Raising or lowering interest rates creates a domino effect across the economy. When rates go up, borrowing money from banks becomes more expensive. That slows down consumer spending and business investments, helping to bring inflation under control. On the other hand, when rates are lowered, borrowing becomes cheaper, which stimulates economic activity and supports job growth. But too much stimulation can lead to rising inflation. That's why the Fed's job is all about finding the right balance. As reported recently, the latest inflation figures in the US are quite interesting. The Fed's most closely watched indicator is the Core Personal Consumption Expenditures Index, or PCE. This index excludes food and energy prices because those tend to fluctuate a lot and could distort the bigger picture. In April, core PCE inflation came in at 2.5% year-over-year. That's slightly lower than the 2.7% in March and in line with expectations. The Fed's target is 2% inflation, so we're still a bit above that, but slowly getting closer. These numbers might seem like good news. So why is the Fed still leaning towards holding rates steady? The answer lies in what some economists are calling the best move for now. According to Jeffrey Roach, chief economist at LPL Financial, April's inflation reading might end up being the lowest we'll see for the rest of the year. In other words, he expects inflation to speed up again in the coming months. But why? The main reason is the potential impact of tariffs introduced by President Trump. One of the key points in the news is exactly this: tariffs. The tariffs Trump placed on imports, especially from China, raise the prices of goods entering the US market. That increases production costs for companies, and they often pass those extra costs on to consumers, which fuels inflation. So the main debate inside the Fed right now is this: will this inflation caused by tariffs be just a temporary jump, or will it turn into a longer-term trend? Some Fed policymakers believe this price increase is a one-time spike and should be looked past. They don't think it changes the core inflation picture across the economy. The White House agrees, and Trump himself keeps urging the Fed to lower interest rates. However, several Fed officials, including Minneapolis Fed President Neil Kashkari, think trade negotiations could drag on for months, even years, and that retaliatory tariffs might push inflation even higher. They point out that tariffs don't just affect finished goods, but also intermediate goods like steel or aluminum that are used in manufacturing. That could disrupt the entire supply chain and lead to long-lasting inflation. They even compare this to the supply chain issues we saw during the pandemic. The minutes from the Fed's latest meeting show that almost all members now see a real risk that this tariff-driven inflation could stick around longer than expected. That risk plays a big role in their interest rate decisions. We should also talk about political pressure. President Trump has been publicly criticizing the Fed for not cutting rates, arguing that doing so would help the economy. These attempts to pressure the Fed actually challenge its independence as a central bank. Fed Chair Jerome Powell has made it clear, even in a meeting with Trump, that monetary policy will only be guided by incoming economic data. This shows the Fed's determination to stay objective and avoid political influence in its decisions. Dallas Fed President Lori Logan has also made a strong statement. She said current interest rates are in a good place and that it takes time for the effects of previous rate hikes to fully show. She warned that lowering rates too quickly just to boost employment could trigger an inflationary spiral, which would hurt the economy in the long run. So, to sum it all up, the Fed is likely to keep interest rates steady. While recent inflation numbers have improved slightly, the central bank is still deeply concerned about the lasting effects of tariffs and potential disruptions to the supply chain. These concerns are reinforced by economists who predict that inflation may accelerate again in the second half of the year. This decision also reflects the Fed's commitment to staying independent from political pressure. They're focused on long-term economic stability, not short-term political wins. So what do you think? Is the Fed making the right choice by holding interest rates steady in today's situation, or should they listen to Trump and start cutting rates?